The trading floors are quiet, screens dark, the ticker display permanently fixed at $79.25. It's the holiday period, a time for rest and relaxation. However, if one were to peer into the executive suites of downtown Manhattan or the meeting chambers of the Federal Reserve, a starkly different scene would unfold. One of sheer panic. We're observing indications of urgent risk management assemblies occurring this very weekend, involving the uppermost echelons of the global financial establishment. The reason? Silver has surged by 10% in a single 24-hour span. A 10% fluctuation in a fundamental commodity isn't merely a market event, it's a solvency crisis. When an asset like silver experiences such rapid price movement, it destabilizes systems. It cripples the risk assessment models employed by financial institutions. It erodes the margin requirements of investment funds. And most alarmingly, it jeopardizes the integrity of the clearinghouse. The clearinghouse serves as the central nervous system of the market, guaranteeing every transaction. Should a major bank be unable to settle its obligations on Monday morning due to a short position in silver, the clearinghouse is obligated to cover the debt. If the clearinghouse itself falters, the entire financial system grinds to a halt. In this urgent bulletin, we will reveal the truth of what transpires behind closed doors this weekend. We will dissect the emergency protocols that banks resort to when cornered. We will examine the potential for regulatory adjustments slated for Monday, including increased margin requirements, position limitations, and trading suspensions. And I will explain why these high-level meetings signify not strength, but a complete abdication of control. The banks are convening because they are gripped by fear of the Sunday night market opening. They understand that if silver surges to $85, the game may be irrevocably over. This is the narrative of the weekend the system faltered. To comprehend the impetus behind these urgent consultations, one must grasp the mathematics of leverage. Financial institutions do not engage in silver trading with their own capital. They utilize borrowed funds. They employ leverage ratios of 20-1 and in some instances 50-1. This strategy yields substantial profits during periods of market calm, generating found money. However, when the market moves 10% against such positions, leverage transforms into an instrument of mass financial destruction. Let's examine the figures. If a bank operates with 20-1 leverage, a 5% adverse price movement results in the complete depletion of its equity. They are wiped out. Silver's 10% appreciation occurred on Saturday. This implies that any entity holding a leveraged short position of 10-1 or greater is now insolvent. Their equity has vanished. They owe sums they cannot possibly repay. Typically, a bank would issue a margin call, compelling the client to meet the deficit. But what if the client is too significant to allow failure? What if the client is a colossal industrial hedger, a sovereign wealth fund, or another financial institution? Liquidating such an entity would precipitate a market-wide collapse. Consequently, a meeting is convened. Regulators and the Federal Reserve are summoned. The message conveyed is, we have a critical issue. If the market opens on Monday, Bank X will default. We require a resolution. This is precisely the scenario that unfolded in 2008 with Bear Stearns, in 1998 with Long-Term Capital Management, and in 1980 with the Hunt brothers. They convened over a weekend to alter the rules, thereby avoiding their financial obligations. We believe the current discussions revolve around containment strategies. They are endeavoring to prevent silver from opening at $85 tonight, as such an event would propagate insolvency from clients to the banks themselves. We are witnessing the potential for a contagion event, with silver acting as the pathogen. Let us delve deeper into the risks associated with the clearinghouse. The CME Group, operator of futures exchanges, maintains a default fund. This fund comprises capital contributed by all member institutions, serving as an insurance mechanism. In the event of a member's default, the fund covers the losses. However, this fund is not limitless. With silver trading at $79, the notional value of short positions amounts to billions. A further price surge could cause losses to exceed the fund's capacity. This represents a catastrophic scenario. If the default fund is depleted, the exchange itself faces existential risk. Market participants lose faith in the exchange, halting trading activity. liquidity evaporates. To avert this outcome, exchanges possess emergency authority. They can suspend trading, escalate margin requirements to 100%, and enforce liquidation-only orders. This weekend, legal counsel is meticulously reviewing contractual provisions, searching for the clause that permits them to deactivate the buy functionality. They implemented this with nickel, they did it with GameStop. Do not presume they will hesitate to do so with silver. They will take any measure necessary to preserve the market structure, even at the cost of its credibility. Now let us address the collateral crisis. Financial institutions utilize government bonds as collateral for their transactions. However, the bond market is currently exhibiting instability. The looming debt ceiling debate and rising inflation are diminishing the value of collateral precisely as liabilities are escalating. This constitutes a dual squeeze. Banks are experiencing pressure on their short positions and on their collateral holdings. This compels them to divest other assets to generate cash. We may observe a decline in stock prices on Monday. Cryptocurrencies might also fall, not due to inherent weakness, but because financial institutions need to sell assets to cover their silver-related losses. This is how a silver squeeze escalates into a macroeconomic event, siphoning liquidity from global markets to address the void in the precious metal sector. The meetings this weekend transcend the scope of silver alone. They are aimed at averting a broader systemic liquidity crisis. They are attempting to isolate the fallout. However, herein lies their predicament. They can manipulate the derivative market and alter regulations on futures exchanges, but they cannot control the physical market. They cannot influence pricing in Shanghai. They cannot dictate the premiums at coin shops. If they suppress the paper market or artificially cap the price, the physical market will inevitably diverge. The price in Shanghai will ascend to $100, while New York's price remains at $79. Consequently, all available silver in the Western Hemisphere will flow eastward to capitalize on the arbitrage opportunity. Thus, their proposed solution exacerbates the problem, accelerating the depletion of existing reserves. They are ensnared. Let us discuss the psychological warfare we are about to witness. During these high-level meetings, a specific narrative is typically disseminated to the press. Anticipate headlines appearing on Sunday afternoon, such as "Regulators monitor commodity volatility," "Financial institutions assure adequate liquidity," or "Experts warn of silver bubble." Their objective is to psychologically pressure the market downwards, aiming to coerce retail investors into selling at the market opening. They require your sell orders to facilitate their own purchases. They need your liquidity to compensate for their miscalculations. However, this time, their propaganda may prove ineffective. The public is no longer heeding the pronouncements of financial institutions. They are observing the price action. They see $79. They observe gold at $4,500. They perceive the reality. The confidence game is faltering, and when confidence erodes, meetings offer no remedy. Only price adjustment can rectify the situation. Therefore, as we await the Sunday opening, it is imperative to understand that the system is manipulated. However, this manipulation is now backfiring. The leverage they employed to suppress prices is now driving them upward. The rules they enacted for their own protection are now ensnaring them. We are observing a systemic breakdown in slow motion. The consequence of this failure is price discovery. The market is seeking the price at which banks cease to incur losses, and that price is significantly higher than $79. The emergency meeting serves as a critical signal indicating that a pain threshold has been reached. Now we will observe their response. Will they confront the situation or capitulate? Let us examine more closely the specific instruments they might deploy on Monday morning. What precisely does a rule alteration entail, and how will it impact your investment portfolio? One of the most prevalent tactics during a squeeze involves increasing margin requirements. They attempted this last week, raising margins by 50% without success. However, they possess the capacity to escalate this further, potentially to 100%. This would necessitate full cash payment for any silver purchase, eliminating borrowed funds and effectively incapacitating speculators. For hedge funds employing leverage, a sudden demand for full cash payment would compel them to liquidate their positions, as they would be unable to finance them. This generates significant selling pressure. In 1980, this exact measure led to the downfall of the Hunt brothers. Margin requirements were raised to such an extent that the Hunts were driven into bankruptcy. However, the circumstances today differ. The purchasers in the present market are not solely speculators. Entities like Samsung and the People's Bank of China are acquiring silver with cash, not on margin. Consequently, while a margin hike might penalize smaller traders, it will not deter large industrial purchasers. These whales possess the requisite capital. In fact, these large players may welcome margin increases as it prompts weaker hands to exit, allowing them to acquire assets at lower prices. The subsequent tool at their disposal is position limits. An exchange can decree that no single entity may hold more than 3,000 contracts. If an entity holds 5,000, they would be compelled to divest 2,000 by Monday noon. This represents direct market intervention, forcing large holders to reduce their positions. However, the market has evolved. If the futures exchange imposes position limits, these large players will simply migrate to the over-the-counter market, relocating to financial centers such as London or Shanghai. Capital is inherently mobile and will circumvent artificial barriers. One cannot thwart a global demand for a commodity by erecting a localized impediment in New York. The ultimate contingency, the nuclear option, is liquidation-only trading. In this scenario, the exchange permits the selling of existing contracts but prohibits the acquisition of new ones. Effectively, they disable the buy button. This guarantees a price decline, as demand is artificially suppressed on the platform. If this measure is enacted, it signifies the end of the futures exchange as we know it. It would irrevocably damage the reputation of the United States futures market. Investors would withdraw and likely never return, seeking alternative exchanges that permit purchasing. Shanghai remains open for business. Dubai is also available. If New York closes its doors, it essentially transfers control of the global market to China. The geopolitical repercussions of a liquidity-only policy are simply too substantial. While they might threaten such action, implementing it would be tantamount to economic suicide for the dollar-denominated financial system. Thus, the banks are cornered. They possess various measures at their disposal, but each carries a significant cost. Every intervention accelerates the exodus from the dollar. Every regulatory alteration confirms the system's inherent flaws. They are attempting to extinguish a wildfire with explosives. The meetings this weekend are an endeavor to orchestrate a soft landing. Their objective is to permit a gradual price increase, managing the ascent in a manner that avoids simultaneous bankruptcy for all involved. However, markets exhibiting vertical price movements are inherently unmanageable. Crowd psychology has taken precedence. The collective has sensed vulnerability. Now let us consider the potential for a gap up in price on Monday morning. Due to these meetings and the pervasive uncertainty, liquidity on Sunday evening is expected to be virtually non-existent. No trader wishes to establish a position before understanding the new regulatory landscape. Consequently, the order book will likely be sparse. Should a buyer emerge, the price could teleport upwards once more. It is conceivable that silver could open at $85 simply because financial institutions are hesitant to sell. Fear operates in both directions. Banks are apprehensive about short positions, and traders are equally wary of shorting. The path of least resistance is upwards, primarily because no one wishes to oppose the prevailing momentum. This potential fear gap is a critical indicator to monitor. A significant opening price increase would signify the failure of the meetings and an inability to devise a solution, indicating uncontrolled panic. Conversely, if the price gaps downwards, with silver opening at $75, it would suggest that a method of market intervention has been successfully implemented, perhaps through a coordinated central bank sale or a regulatory change. Should this occur, do not panic. It presents an opportunity. It is the system offering a final chance to acquire physical metal at a suppressed price before the intrinsic realities of the market overcome the paper-based system. One must learn to interpret the implications of the price gap. An upward gap signifies a loss of control. A downward gap indicates a temporary intervention. Ultimately, both scenarios portend higher prices, but the trajectory will differ. We must also consider the perspective of physical metal dealers. They are observing these deliberations closely. They recognize that if the rules are altered, their hedging strategies could become invalidated. Consequently, they are maintaining elevated premiums to safeguard their inventory. It is unlikely that the current dealer restrictions will be lifted on Monday. In fact, if market volatility persists, we may witness further dealer shutdowns. The divergence between spot prices and physical prices will widen. We might see spot silver trading at $80 while physical metal commands $110. This spread represents the risk premium associated with a fractured system. As an investor, your focus should remain on the physical price, which represents your net worth. The paper price is merely a numerical display utilized by banks for settling speculative trades. The physical price reflects the actual value you can obtain for your metal in the real world, and the real world is currently signaling higher valuations. Thus, the lights are on, coffee is brewing, lawyers are arguing, and the weekend meetings are dragging on. They are searching for an exit strategy. However, no true escape route exists. They have orchestrated the sale of more silver than is physically available, and now the rightful owners are demanding its return. This is an age-old financial narrative, a short squeeze on a finite asset. One cannot manufacture silver through printing or legislation. It must be mined or purchased, and currently they are incapable of achieving either. Monday is approaching. The reckoning is imminent. Maintain your resolve. We must examine the ripple effect, the contagion. The meeting this weekend is not solely about silver futures contracts. It concerns the foundational mechanisms of the entire financial system. Silver does not exist in isolation. It is intrinsically linked to the repo market. The repo market functions as Wall Street's pawn shop, where banks engage in overnight lending, utilizing collateral such as treasury bonds. However, when significant volatility impacts a core asset class, such as a 10% surge in silver prices, it disrupts the risk assessment models governing the repo market. If a bank is depleted of cash to satisfy silver margin calls, it ceases lending in the repo market and hoards its funds. This leads to a dramatic escalation of overnight interest rates, triggering a liquidity freeze. We witnessed a similar phenomenon in September of 2019 when the repo market collapsed, necessitating immediate intervention by the Federal Reserve, injecting billions into the system. There are indications that the surge in silver prices is inducing a comparable disruption in these critical financial channels. Banks are regarding each other with suspicion, questioning each other's solvency and exposure to silver short positions. When trust erodes, credit evaporates. And when credit disappears, the stock market plummets. This explains the Federal Reserve's involvement in these weekend consultations. Their primary concern is not the price of silver, but the stability of major institutions like JP Morgan. If JP Morgan faces liquidity challenges due to a compromised balance sheet, the Fed must intervene. This is the concept of the Fed put. However, the irony is profound. If the Fed intervenes to rescue the banks, it must resort to printing money. Increased money supply inevitably leads to higher silver prices. They are trapped in a self-perpetuating cycle. To avert systemic collapse driven by high silver prices, they must implement policies that precisely fuel higher silver prices. Now let us shift our focus to the resurgence of mining entities. While bankers are experiencing anxiety in New York, mining company chief executive officers are celebrating. For the past decade, mining operations have been subjected to unfair practices within the derivatives market. They extracted the raw material, while bankers dictated the price, operating on razor-thin profit margins while financial institutions amassed fortunes trading paper. Today, the balance of power has fundamentally shifted. The miners possess the one commodity the banks desperately require, physical inventory, and they are refusing to sell. Reports indicate a deliberate withholding of production. Mining companies are opting to stockpile their output at their mine sites rather than delivering it to refineries at the current prices. The rationale behind this decision is their recognition of the ongoing squeeze. Why sell at $79 today when a price of $100 is achievable next week? They are functioning akin to a central bank, managing their reserves strategically. This creates a supply vacuum. Banks were anticipating a continuous influx of new mine production into futures exchanges to alleviate price pressure, but this supply is not materializing. It is being held in vaults. This compels banks to offer even higher prices, effectively bribing miners to release their metal, and the miners are demanding exorbitant sums. We must also re-examine the risk of nationalization. It is Sunday. Governments in Latin America are closely monitoring price developments. Mexico accounts for 25% of the world's silver production. If silver reaches $100, do you believe the Mexican government will permit foreign corporations to retain all the profits? Unlikely. They will likely implement windfall profit taxes or mandate that a certain percentage of silver production remain within the country for strategic reserves. Should Mexico announce export restrictions on Monday morning, the price of silver could instantaneously double. The banks are acutely aware of this risk, which explains their widespread panic this weekend. They are exposed to geopolitical events beyond their control. They have taken significant short positions in a strategic asset located in foreign jurisdictions, presenting the ultimate unhedgeable risk. Let us discuss the rumors of shadow bank failures. In every financial crisis, there is an unforeseen casualty. In 2008, it was Lehman Brothers. In the current crisis, it is likely to be a shadow bank or a large commodity trading advisor. These are unregulated financial entities that operate with substantial leverage and lack the safety nets available to major banks. Whispers are circulating that a prominent commodity fund based in London has collapsed. Their positions were short silver and long bonds, both of which have moved adversely. If this fund is liquidated on Monday, it will trigger massive market orders to purchase silver. This constitutes forced buying, irrespective of technical resistance levels or overbought indicators. It is a relentless acquisition until the position is closed. This is the fuel for a significant price surge. We are not merely observing organic demand, we are witnessing the mechanics of liquidation. A liquidation event creates a price vacuum, propelling the price upward far more rapidly than any fundamental news could achieve. Furthermore, occurring during the holiday period intensifies this vacuum. Now, let us consider the involvement of the technology sector. In a previous analysis, we discussed Samsung than Microsoft. Do you believe their procurement teams are resting this weekend? No, they are working overtime, attempting to secure off-market deals. They are directly contacting mining companies, offering to purchase their entire future production, such as for 2026, and dictating their own price. If a mining company enters into an agreement with Microsoft that silver will never reach the public market, it will be sequestered. This further diminishes the available supply. The visible inventory on futures exchanges is shrinking as private corporate stockpiles expand. This represents the privatization of supply. The market is bifurcating. There is the public price, characterized by volatility and dysfunction, and the private price, which is considerably higher. The banks are trapped in the public market, attempting to cover their short positions in a dwindling pool being drained by the private market. Let us address the strategy for the Monday morning price gap. If you are holding cash, you are likely experiencing apprehension. You wish to invest but are hesitant to purchase at a potential peak, hoping for a price retracement. However, in a liquidity crisis, pullbacks are typically shallow and brief. If silver opens at $85 on Monday, do not immediately chase the price. Wait for the initial trading hours volatility. Typically, after a significant upward gap, profit-taking occurs within the first hour of trading, leading to a temporary price decline. The price then tests the breakout level, presenting an entry point. However, be forewarned. In a runaway market, the dip may never materialize, and the price could simply reach its upward limit and remain there. In such a scenario, you would miss the opportunity. This underscores the critical importance of not remaining entirely in cash. Establishing a core position that you never trade provides protection against such extreme price movements. Now let us examine the correlation with gold. Gold is trading at $4,534, exhibiting stability and strength, acting as an anchor. As long as gold maintains these levels, silver cannot experience a significant decline. A sharp drop in silver to $50 would cause the gold to silver ratio to surge to 90. Arbitrage algorithms would immediately initiate selling gold and buying silver to narrow this discrepancy. Therefore, gold provides a mathematical floor for the silver price. Banks cannot aggressively suppress silver without impacting gold. And suppressing gold is considerably more challenging as central banks are actively purchasing it. One cannot intimidate a central bank. Consequently, the banks are engaged in a two-front war and are losing both battles. Let us revisit the issue of media silence. Why isn't this momentous news gracing the prominent display of the Wall Street Journal? The reasoning is clear. They aim to preempt widespread alarm. Should the general populace grasp the dire insolvency of financial institutions or recognize the rapid deterioration of our currency's value, the inevitable consequence would be a mass exodus from banks, followed swiftly by a depletion of essential goods from retail outlets and the onset of hyperinflationary anxieties. Consequently, the media deliberately sidesteps these critical issues, opting instead to focus on corporate performance reports or political controversies. Their strategy involves diverting the masses, yet the populace is exhibiting signs of awakening. Google Trends offers irrefutable evidence. Search queries for the price of silver have skyrocketed. Individuals are bypassing the usual media intermediaries, seeking information directly from its source. This organic surge of awareness possesses considerable potency. It signifies that the forthcoming surge in demand will manifest in tangible assets, not mere paper agreements. We are talking about physical coins and bars. These are the very items that financial institutions are incapable of replicating. They can generate a futures contract at will, but they cannot conjure a silver eagle out of thin air. As we anticipate the markets opening on Sunday, the atmosphere is charged with peak tension. Deliberations are ongoing, with authorities seeking a financial lifeline and adjustments to existing regulations. However, their window of opportunity is rapidly shrinking. The dawn is breaking over Asia, signaling the imminent commencement of trading. The moment of truth is fast approaching. In the subsequent segment, we will delve into the projected price levels. If the price breaches the $80 mark, what lies ahead? Will it ascend to 90 or perhaps 100? We will examine Fibonacci extensions and optimistic market projections. Furthermore, we will explore the psychological fortitude required to retain assets amidst daily fluctuations of 20% in net worth. Kindly remain attentive. The canvas of the market is poised for its depiction. Let us scrutinize the technical trajectory. When an asset surpasses its all-time highest valuation, it enters a phase known as blue sky. This is a technical designation signifying uncharted territory, devoid of historical price data to guide predictions. There are no prior resistance levels from a decade ago, nor are there existing holders poised to divest. It is an expanse of pure possibility. Within this blue sky realm, conventional analysis falters. One cannot extrapolate future price movements by examining past chart data. So, how do automated trading systems determine their selling points? They employ Fibonacci extensions, which are mathematical relationships derived from natural phenomena designed to forecast human behavior in the absence of other indicators. Presently, the price stands at $79.25. If we measure the ascent from the breakout point of $50, the initial significant Fibonacci extension target registers at the 1.272 level, projecting a price of approximately $85. This represents the first magnetizing threshold. Upon the market's reopening on Sunday evening, automated systems will be programmed to propel the price towards $85, functioning akin to a powerful gravitational pull. Should the $85 barrier be surpassed, the subsequent objective becomes the golden ratio, the 1.618 extension, targeting a price near $96. Immediately beyond that lies the psychologically significant benchmark of $100. Thus, the path forward is clearly delineated: 85, 96, 100. These are not arbitrary estimations, but rather mathematical waypoints utilized by high-frequency trading algorithms to navigate the unknown. They will continue their buying activity until these levels are reached, at which point they will pause before re-engaging. However, blue sky also incorporates a human element: euphoria. When an asset's price consistently achieves new all-time highs on a daily basis, it cultivates a self-reinforcing cycle of public attention. The media is compelled to cover it, and the public cannot ignore it. This generates a viral chart phenomenon, widely shared across social media and discussed in everyday conversations. This widespread excitement serves as the catalyst that propels the price through the Fibonacci levels, injecting the fresh capital necessary to sustain this vertical ascent. We are witnessing a transformation from a purely technical breakout to a social phenomenon. And social escalations are inherently unpredictable, forceful, and remarkably lucrative. Now let us address the surge in individual investor participation. We have touched upon this, but it is crucial to comprehend the magnitude of this awakening giant. The general public holds trillions of dollars in savings accounts, yielding negative real returns and equivalent sums in checking accounts. Historically, the public tends to enter bull markets as latecomers, but their eventual influx injects a tidal wave of capital that dwarfs institutional investments. Currently, the public is stirring from its slumber, but faces a critical hurdle: accessibility. In 1980, one could readily acquire a substantial quantity of silver from a local coin dealer. Today, in 2025, coin shops are depleted, online vendors are overwhelmed or sold out, and exchange-traded funds are trading at premiums. Consequently, where does this retail capital ultimately flow? It directs towards mining equities. This represents the path of least resistance for the average investor. They access their brokerage application, search for silver-related investments, and acquire the first mining stock they encounter. This is precisely why we anticipate the mining sector to experience parabolic growth next week. It is the sole avenue through which retail capital can be effectively deployed. If you are currently invested in mining stocks, prepare yourself. You are poised to receive a substantial infusion of liquidity from countless retail investors eager for exposure but unable to procure physical precious metals. Penny stocks will transition to dollar stocks, and dollar stocks will ascend to $10 valuations. This represents the cascading effect of the shortage, where scarcity in the physical commodity compels capital into the equity markets. Let us now examine the psychological barrier of $100. The prospect of a three-digit price seems inconceivable to those who recall silver trading at $5. However, within an environment of hyperinflation or currency crisis, zeros are rapidly appended. Consider the trajectory of Bitcoin, which surged from $100 to $1,000 within a single month. When fundamental paradigms shift, so too do denominations. $100 signifies a shift in unit bias. Individuals will begin acquiring silver by the gram rather than the ounce. Retailers will adopt pricing in grams to make the purchase appear more economical. Offering a gram of silver for $3 sounds considerably more appealing than presenting an ounce for $100. This marketing adjustment opens the market to the smallest investors, those with even $50 at their disposal, effectively democratizing the squeeze. And 1 million small-scale purchases are far more formidable to counter than a single large entity. One cannot issue margin calls to 1 million individuals who paid cash for a gram of silver. Furthermore, we must revisit the industrial substitution argument. Financial institutions are banking on the assumption that at the $80 price point, industrial demand will cease. They anticipate demand destruction. However, we understand this premise to be flawed. For applications like missile guidance systems, the cost of silver is a negligible concern. Similarly, in the manufacturing of solar panels, silver represents a minimal fraction of the overall expense. However, there exists a counterbalancing factor: the stockpiling in anticipation of further price increases. If a chief executive observes silver prices trending towards $100, they will not curtail their purchasing. Rather, they will acquire more than is immediately necessary, securing a 2-year supply at the current price. They will rationalize that purchasing at $79 positions them favorably when the price reaches $150. Consequently, elevated prices can paradoxically stimulate industrial demand in the short term, triggering a hoarding response within corporate entities and further reducing the available supply of the metal, thereby exacerbating the shortage. The financial institutions are relying on elementary economic principles while we are operating within the domain of behavioral economics. Essentially, they are consulting the wrong academic resources. Now let us return to the emergency summit. What constitutes the ultimate recourse for regulatory bodies? If they prove incapable of arresting the price escalation, and if the clearinghouse faces collapse, their ultimate strategy might involve demonetizing silver. They could enact legislation prohibiting silver's use as collateral, escalate taxes on silver profits to 80%, or even outlaw private ownership of bullion. These represent the extreme risks of the endgame scenario. We have not yet reached this juncture, but awareness of these possibilities is imperative. When a government forfeits control over its currency, it inevitably targets alternative stores of value. Silver stands as such an alternative. This underscores the paramount importance of privacy. Should silver be outlawed or subjected to exorbitant taxation, it is crucial to ensure your holdings remain undisclosed off the official books. The premium associated with the black market, which we have previously discussed, represents the cost of such discretion. Should the government move against silver, the black market price will double. Therefore, governmental intervention, despite its intimidating nature, ultimately benefits physical silver holders. Let us examine the currency swap agreements. The Federal Reserve maintains reciprocal currency arrangements with other central banks, enabling them to inject dollar liquidity into the global system and maintain financial stability. This weekend, these swap lines are undoubtedly operating at maximum capacity. The Fed is supplying dollars to European and Japanese institutions to offset their losses on commodity-backed assets. This action results in a substantial influx of new dollars into the financial ecosystem, thereby increasing global liquidity. And what floats upon this expansive sea of liquidity? Tangible assets. Thus, the very mechanism employed to rescue the financial institutions inadvertently fuels an upward trajectory for silver. They have effectively cornered themselves, sacrificing the currency's value to preserve the integrity of the market structure. This is the very definition of a crack-up boom, where the market ascends precisely because the currency is in decline. Let us now focus our attention on the Monday morning market opening. We have discussed the price gap, but what of the volume profile? Typically, early trading in the Asian session is characterized by low volume. However, this time, I anticipate exceptionally high trading volumes immediately upon the market's commencement. The reason for this is the waiting arbitrageurs. They are observing the price in Shanghai and the price in New York, poised to capitalize on any discrepancy. If we witness substantial trading volume at the opening bell, it will serve as confirmation of the move's legitimacy. Conversely, if a price surge occurs with minimal volume, it could indicate a deliberate deception. Low-volume spikes are easily reversed, whereas high-volume spikes possess genuine substance. Therefore, pay close attention to the volume bars. If millions of ounces are traded within the first hour, it signifies capitulation by the major financial institutions. If the trading remains subdued, they may be orchestrating a covert maneuver later in the day. We must also monitor the price of oil. Crude oil acts as a benchmark commodity. If oil prices surge on Monday due to geopolitical instability, it will exert upward pressure on silver. Elevated oil prices translate to increased operational costs for mining companies and heightened inflation expectations. Silver and oil share a symbiotic relationship, often moving in tandem during periods of crisis. Should oil surpass $80 or $90 per barrel, silver will instantaneously breach the $80 threshold. Finally, let us consider bond yields. An escalation in the 10-year Treasury yield would signal a bond market collapse. While typically higher yields negatively impact silver, in a sovereign debt crisis, they can actually benefit silver by indicating a loss of governmental control. If yields spike and silver concurrently ascends, this would be a definitive indicator of a sovereign debt crisis, signifying the market's rejection of government securities. We observed this phenomenon in the 1970s, and history appears poised to repeat itself. Therefore, the checklist for Sunday evening comprises the following. Observe the price gap. Will it open above $80? Monitor the volume. Is it robust or anemic? Examine gold. Is it holding steady at $4,500? Track oil. Is its price increasing? Analyze yields. Are they exhibiting a sharp rise? If all 5 indicators align positively, there is no discernible ceiling. The price will advance to $85, then to $90. The emergency summit will have proven ineffective and the free market will have prevailed. In the concluding section, we will synthesize our findings. We will provide a definitive action plan for Monday morning trading. What precisely should be your course of action upon the market's opening? Should you acquire, divest, or hedge your positions? I will outline the precise steps to safeguard your assets in a market experiencing significant upward momentum, and I will offer a final reflection on why this particular weekend has proven to be a watershed moment. The world prior to this weekend and the world that follows are fundamentally distinct. The era of paper assets is drawing to a close. The age of tangible assets is dawning. Kindly remain engaged. The conclusion is imminent. We have reached a pivotal juncture, a moment of decision. Over the past hour, we have meticulously analyzed the emergency meetings, the operational failures of the clearinghouses, and the industrial panic that is engulfing the silver market. We have scrutinized charts, examined geopolitical factors, and delved into the underlying mathematics. Now it is imperative to turn our attention to your investment portfolio. In less than 24 hours, the markets will resume trading. The automated trading systems will be reactivated and capital will begin to flow. You will confront the most volatile trading session of your lifetime. The choices you make or fail to make within the first hour of trading could profoundly shape your financial future for the ensuing decade. In this final chapter, designated as Part 4, I will present your Monday morning action plan. I will meticulously guide you through navigating a market experiencing limit-up conditions. I will provide a contingency strategy for the most adverse scenario, that of an exchange closure, and I will equip you with the essential psychological fortitude required to maintain your position while the rest of the world succumbs to panic. The deliberations have concluded. The financial titans have made their pronouncements. Now, the responsibility rests with you to make your choice. Let us bring this to a resolute conclusion. The primary directive for Monday's market opening is straightforward. Do not sell. While this may seem self-evident to long-term holders, the temptation to liquidate when witnessing a price gap up and a rapid 10 or 20% increase in account balance will be immense. You might rationalize selling now and repurchasing on a subsequent decline. This, however, is a precarious trap. In a liquidation event, which is precisely what we are experiencing, a significant price retracement may not materialize. If financial institutions are compelled to cover their positions, they will absorb every available contract. If you liquidate your holdings at $82, you may never have the opportunity to reacquire them. You could witness the price ascend to $85, $90, or even $100 while you remain in cash, desperately hoping for a market correction that never materializes. You are exchanging a scarce asset for an abundant one. In a period of crisis, prudence dictates holding on to scarcity. Unless you face an immediate and urgent need for cash to settle obligations, refrain from selling. Allow the market to advance. Let the short sellers endure their predicament. Permit the price to discover its true intrinsic value. Your patience will be your ultimate recompense. The second step pertains to risk management. If you possess physical silver in your direct custody, you may disregard this instruction as your assets are secure. However, if your silver is held through a vaulting service, an exchange-traded fund, or a brokerage account, you must immediately scrutinize your counterparty arrangements. Thoroughly review the terms of service, paying particular attention to clauses pertaining to force majeure and cash settlement. In the event of a trading halt, does your custodian retain the authority to liquidate your holdings at the last executed price? If the answer is affirmative, you are exposed to significant risk. This weekend, you should seriously consider migrating your assets out of the traditional banking system and into secure, private, non-bank storage facilities. If you own an exchange-traded fund, contemplate divesting from it and acquiring physical metal or investing in mining equities. While mining stocks carry inherent equity-related risks, They do not possess the same delivery-related uncertainties as paper silver contracts. You own a share in a company that possesses tangible subterranean assets. A physical deposit cannot invoke a force majeure clause. The silver is demonstrably present. We are transitioning into an era where physical possession is paramount. If you cannot physically touch your assets, you may discover that you no longer truly own them when the market turbulence subsides. We must address the possibility of an extreme scenario. What if the financial losses are so catastrophic that the exchanges remain closed on Monday? Alternatively, what if they open, immediately hit their upward limit, and then announce an indefinite suspension of trading to maintain market stability? Such events have occurred previously, notably with nickel and during the Hunt Brothers market manipulation. This is a genuine risk. If the exchange ceases operations, the spot price will become static, potentially remaining at $79.25 for an extended period. However, the actual market price for physical transactions will diverge significantly. In a frozen market, the black market assumes dominance. Dealers will commence trading based on prices observed in Shanghai or purely on prevailing supply and demand dynamics. You might observe a spot price of $79, while American Eagles are trading at $120. If this scenario unfolds, do not succumb to panic. A closed exchange serves as the ultimate validation of your investment thesis. It signifies the complete failure of paper-based market manipulation and heralds a substantial upward repricing of the commodity once trading eventually resumes. Do not liquidate your physical silver at the frozen spot price. Disregard the screen displays. Await the dissipation of the chaos. The true valuation of your silver is not dictated by a malfunctioning computer system in New York, but rather by the fundamental principles of scarcity. Now let us explore the opportunities that lie ahead. If you have missed the recent surge in the physical commodity or wish to augment your current holdings, where should your attention be directed? The answer lies with mining companies. We have previously discussed this, but the specific setup for Monday is noteworthy. If the physical commodity experiences a price gap up, mining stocks are expected to open significantly higher, though they will likely exhibit high beta characteristics. In other words, if silver gains 10%, mining stocks might appreciate by 20%. However, there is a particular segment of the mining sector that warrants closer examination: the developers. These are companies that have identified silver deposits but have not yet commenced extraction operations. In a bearish market, these stocks are typically depressed due to a lack of funding for new mining ventures. Conversely, in a bullish market, particularly one characterized by a shortage-driven squeeze, these companies become prime acquisition targets. Major mining corporations are facing dwindling reserves and possess ample capital from high silver prices. Their strategic imperative is to acquire underground ounces to ensure their long-term viability. Consequently, they will initiate the acquisition of development stage companies. We are on the cusp of a wave of mergers and acquisitions. When a smaller mining entity is acquired, the premium is typically substantial, often in the range of 40 to 50% overnight. This represents the lottery ticket phase of a bull market. If you possess a higher risk tolerance, consider investigating high-grade development companies situated in politically stable jurisdictions. They are poised to be the next significant catalyst in this unfolding scenario. I wish to provide you with a conceptual framework for managing this volatility. Cease measuring the value of your silver in dollar terms. The dollar is depreciating, while silver is appreciating. The chart effectively illustrates the collision of two entities in motion. Instead, evaluate your silver and the other assets based on their relative purchasing power. How many ounces of silver are required to acquire a median-priced home? In 1980, this figure approximated 800 ounces. Today, at a price of $79 per ounce, it requires approximately 5,000 ounces. We have not yet reached the historical parity, and there remains a considerable distance to travel to regain the purchasing power observed in 1980. How many ounces of silver are necessary to purchase the Dow Jones Industrial Average? We have addressed this. The ratio must contract significantly. By focusing on real-world purchasing power, you can emotionally detach yourself from the fluctuating dollar value. You will recognize that $79 is merely a waypoint on a much larger journey, not the ultimate destination. The true objective is financial independence, and achieving that level of security requires significantly more than $79. Prepare yourself for a negative shift in public discourse. As the price escalates, political figures will inevitably intervene. They will vilify silver investors, labeling them as hoarders, speculators, or economic saboteurs. They will assert that we are jeopardizing the green energy transition. Their aim will be to induce shame and pressure you into divesting your holdings. This is nothing more than propaganda. You're not a terrorist. You're a prudent investor who recognized the inflationary pressures before they were officially acknowledged and foresaw the impending shortage before it became apparent. You are being rewarded for your foresight. Do not permit them to guilt you into relinquishing your position. The current predicament was engineered by governmental policies of excessive money printing and the stifling of mining operations through over-regulation. The market is now rectifying this situation by driving up prices. You are simply benefiting from this necessary correction. Stand firm in your conviction. Therefore, here is your checklist for the market opening. First, verify the price in Shanghai. Is it leading the trend? Second, check the Globex opening. Will there be a significant price gap? Third, monitor the news. Are there reports of additional bank failures? Fourth, observe the dealers. Are they actively selling? If the answer to all of these questions is affirmative, then we are witnessing vertical price acceleration. The most effective strategy in this scenario is inaction. Rest your hands. Allow the market to run its course. Do not attempt to profit from minor price fluctuations. You risk forfeiting your advantageous position on this upward trajectory. If the market opens with a price decline, indicating a potential rug pull scenario, scrutinize the trading volume. If the volume is notably low, it suggests a manipulative maneuver, and purchasing during this dip would be advisable. However, if the volume is substantial and news emerges of Federal Reserve intervention, we will need to reevaluate. At present, the probability of a market crash is low, while the likelihood of a melt-up scenario is high. We are living through a historical event. Generations from now, financial historians will meticulously study the silver squeeze of 2025. They will author definitive accounts of the weekend when the major financial institutions faltered. They will analyze the very charts that we are currently examining. You are not merely an observer of these events. You are an active participant. You are among the discerning investors who perceived the cracks in the dam before it ultimately breached. This is a rare and exceptional privilege. Most individuals navigate their entire lives without ever experiencing a significant wealth transfer. You are here and you are prepared. Do not squander this extraordinary opportunity through impatience. Do not let fear dictate your actions. The underlying mathematics are immutable. The debt burden is unsustainable. The physical supply of silver is becoming increasingly inaccessible. The price is inevitably destined to rise, and its ascent is accelerating rapidly. Therefore, here is the conclusive assessment. The emergency meeting served as a demonstration of weakness, not strength. The financial institutions are exhibiting panic because they have lost control. The physical market has successfully wrested control from the paper market. Monday morning's trading will be characterized by chaos, a cacophony of activity, and a palpable sense of unease. However, for those holding silver, it will prove to be a profitable endeavor. $79.25 represents the foundation of this new paradigm. $80 is the gateway, and $100 is the immediate target. Obtain adequate rest, ensure your security measures are robust, and prepare yourself for the market's opening. The most spectacular financial event on earth is about to commence. Subscribe.